Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It was a poor session yesterday. The markets, of course, reeling under a lot of selling pressure. That FII number was a really big, stark one. We are, of course, one day. This is a session, and then we go into a midweek holiday. Wednesday is a market holiday, so there is that to boot as well. I'm Prashant. With me, my colleagues Nigel and Rima is with us today. Guys, hi, good morning.
Hi, good morning. Do you get the feeling that the season's changing? It's so much warmer in Bombay. IMD's issued a heat wave. Another question is, if the season is changing, is the market, also going to change a bit?
Well,
that's the hope.
Mood is very, very somber, and I think we could see more of the same maybe till mid of March, and then hopefully things recover towards the end of the fiscal. But mood is extremely somber as we speak. And yesterday's session gave you good reason, to be rather somber. The only bright spot was few stocks did well. So still pick and choose. The breadth of the market wasn't that bad. But I think we'll talk about that in more detail.
No, absolutely. But that heat wave, you're absolutely right. Heat wave in February, right?
And I heard there was no electricity in your building.
But it was an incident, and thankfully everybody was safe. So, but yeah, it was a warm night, and anyway, let's just hope things for the market look a little better. And we've got just to sort of take it from the top where we begin tracking things. US equities last night lower. NASDAQ down about 1.2% or so. S&P was down about a half a percent. The 10-year yield 3 basis points lower to about 4.4%. Dollar index about 0.25% higher to 106.7. Actually, on both yields and the dollar, it's more of the same. On Friday, we had that big crack. Bonds went up, yields went down, and we saw that same continuation in that sense. Dollar went up on Friday as well, so there is that. But of course, compared to the equity sell-off that we saw on Friday, last night was a bit milder, but still in the NASDAQ, that's about 1.2%. Now, in terms of news flow, you had the French president, Macron, visiting the White House, and there was a press conference. And they both sounded their commitment to ending the Ukraine war. Macron, of course, saying that, well, peace should not mean a surrender, to surrender Ukraine or the Ukrainian position. But of course, both agreed that Europe needs to do more to take care of its own security and not depend entirely on the United States. On tariffs, and this was, of course, not about tariffs, but there was a question with regards to tariffs in Mexico and Canada, which as has been advertised, will come into effect in March. And, Trump was asked whether those are on track, and he said, well, they will go forward. So presumably that happens next week. Some other news flow, stock-specific, company-specific. This is all from the tech space. Microsoft reportedly has cancelled its AI data center capacity in the US. There was another report in this publication called The Information, which essentially said that they're now also going to steer away from what OpenAI wants to do with Stargate, which is, of course, the project, the AI build-out project, which was announced from the White House with, 3 or 4 players coming together. But Microsoft seems to be pedaling back a little bit. Stock was not anything; it was not big damage, down about 1% or so. But I think it's going to be something important to watch. Alibaba was down 10%. Trump called for limiting spending in China on technology and other strategic sectors. So that's been the big one, right? I mean, it's up about 55%, maybe 60% even after yesterday's fall, YTD. NVIDIA earnings tomorrow in the same sort of AI tech space. And I think this is going to be important when we come back on Thursday morning. No markets tomorrow. So that's the news flow. Nothing dramatic in that sense, one way or the other. It was broadly lower as far as US equities go. Now, to sort of summarize the levels here, the market broke the support of 22,600 yesterday. 22,620 was the level that we put out, and we traded under it. We closed under it. Nothing. It's not a significant break, but we're below it. So that's the first. And then, of course, the downside level is 22,396. That's another sort of, 200 points away from where we are as of yesterday. And if all of this has got to be negated, we got to take out the prior high of 23,050. That's the upside level which the Nifty needs to break out above. No signs of that as of yet. Bank Nifty also broke its previous low. Downside level, similarly, for the Nifty Bank is 47,844. And that's about 2% away from where we left off. And breaking above the high of 49,628 will be good for the Nifty Bank. But again, here, for a while, it was looking like the Nifty, Bank Nifty is going to be outperforming, and it was outperforming the Nifty, but that's also fallen in line. Relatively, it's lost less as compared to the Nifty, but yesterday it broke the earlier low. GIFT Nifty will come up on your screen, gives you an indication how we're likely to start. It's a flattish start, down about 20 points or so. Guys.
Well, I think the big story overnight is the kind of selling we've seen from FIs in the Indian market. So yesterday, the FIs sold 6,300 crore in the cash market. The DIIs bought, but they bought 5,200 crore, but it's a very large sell figure from the FIs. So unabated selling pressure has now taken the FIs selling to 43,000 crore in the month of February. And there's always that fear, right? Money's moving out of India into other markets. And year to date, just look at MSCI China versus MSCI India. MSCI China is up 16.5%, while the MSCI India index is down close to about 7%. In rupee terms, the Nifty is down a little more than about 4%. The mood across Asia is also very, very somber. This whole, the fact that tariffs are back has hit market sentiment. It's a deep cut across Hang Seng. That's down nearly about 1.6%. Taiwan is down 1%. The Chinese markets are down close to about 0.5%. Bank of Korea, in other news, has cut interest rates by 25 basis points. It's the lowest at 2.75% current rates. It's the lowest since August of 2022. And this is the third rate cut by the Bank of Korea in the last 4 meetings. What to watch today? Remember, it's a truncated week. Tomorrow, Indian markets are shut. But today, you've got BSE's monthly expiry, and the Nifty expiry will take place on Thursday. IMD has issued a heat wave alert in Mumbai on 25th and 26th. That's today and tomorrow. In terms of U.S. economic data, it's consumer confidence, house price index, and there's also the Tata Steel investor meet. And then you've got the NASSCOM, the Assam Summit, etc., that investors will be watching out for headlines.
Well, that's right. And not too many positives in yesterday's trading session, but one positive was the Nifty Bank. That was fighting back from the low point of the day. So that was good news, actually, because it came off closer around 350 to around 400 points. And we're looking at an index that won't be worried by Trump's tariffs. And, it's more domestic facing in nature, and valuations are fairly okay. That'll have to be the Nifty Bank. So good recovery is what we saw in yesterday's trading session. The other one is the India VIX. It cooled off yesterday. It didn't spike up on a day that the Nifty was low by close to 250 points. So that's another positive that I'll be looking at as well. Cooling down of the VIX is something that normally sends out a more positive signal. Next up, what do the FIs do? Not just they're selling in the cash market. They feel that they're in control of these markets because the kind of shorts that they're adding, they're already sitting on elevated net short positions, and they've added close to around 11,000 contracts, which means that, in fact, the short positioning is at around 85%. And the last few sessions we were mentioning, right, that the FI net short positions at around 1.7, 1.8, 1.85 lakh contracts. Take a look at it. In a matter of a few sessions, from 1.85 lakh contracts, it's now at around 2 lakh contracts. So they have aggressively net short. So, at some point of time, you'll expect them to cover up the shorts, but for the time being, they're very much in control. And there's no signs of them covering shorts because of the cash market selling that we are seeing. The other technical factor that will favor the bulls for a technical bounce. Remember, the structure is very, very weak on the Nifty. But when we have seen that the PCR moves to around 0.65 to around 0.67, from there, we normally see a bit of a bounce. Yesterday, it ended at around 0.71. So I think at some point of the day, that PCR could move down to that crucial technical level of around 0.65 to around 0.67. And from there, I don't rule out a bit of a bounce in today's trading session. So that's going to be important. Since we have expiry that's going to be playing out in the next couple of days, and this is the monthly expiry, there it appears there's a short straddle at place at around 22,600. That is, you write both these two strikes, you pocket the premium, which is roughly around 200 rupees or thereabouts, and you add 200 rupees to 22,600 and you deduct it from there, which gives you a broad range. On the downside, 22,400 seems to be, the level that the bulls will want to protect. And on the upside, it seems it's 22,800 odd mark. So it's a broad 400-point range. Remember, tomorrow's a holiday, so we just have today. And then you have Thursday, where monthly expiry does play out. Moving to the Nifty Bank. That's the one that fought back in yesterday's trading session. But what can change things of sorts is, on a day-to-day basis, it's been making lower highs, as you can see. So today you'll want it to trade above these levels, and in fact you'll want it to defend yesterday's low as well, which was roughly at around 48,200 or thereabouts. So that's a crucial support level for the Nifty Bank, 48,000 to around 48,200 or thereabouts. And just one factor, in yesterday's trading session, the breadth of the market wasn't so bad. You had around 600, 650 stocks that are advancing. And one cue as well is look out for some promoter buying. You know, there is select mid-cap, so you're seeing promoter buying. So I think that should be on your radar as well. That's normally a good sign.
All right. Rajiv Agarwal is with us now, Managing Partner and Fund Manager at Doordarshi India Fund. Rajiv, good to have you with us here. Good morning. Thanks very much. The news flow continues to be a little muddy with everything which is happening around the world. But there's a new element to the sell-off in the US. How much, what's your sense, Rajiv? What are you picking up? Are we going to have to deal with the US markets also coming off a little bit more?
Good morning, Prashant. So on the US markets, I do think that the US markets have been at an elevated level. And so I think some pullback from here is, in our mind, a good thing because, markets in US ran up 25% last year and another 25% plus in 2023. And so if we look at from a price to earnings or many other factors, they were very elevated. I think what has started happening now is as the Trump actions start biting, the people are realizing that maybe they have taken the market too high. And so I think there is some pullback because of that. What will happen from here? I think it will much more depend on what the policy measures are, because if some of the tariffs do come into existence, then there will be a lot more inflation, yields will be higher, and that may actually depress the stock prices.
Rajiv, when we spoke to you at the start of the new year, you were quite bullish on India and you were looking at opportunities to buy. Now, while since then, we've had quite a gut-wrenching fall in the Indian market. So what has been your approach in the last 1.5 months?
So I think we are nibblers, Rima, and that is what we like to do. I think these markets are giving us opportunities to buy. And so we are buying, but obviously we have limited capital. So we have to recycle our capital, get out of some other stocks and get into new stocks. And so that's really what our approach has been. I think definitely this pullback has created a lot of opportunities, and you have to then pick your spots and act.
Tell us about, which stocks you've exited, which stocks you've entered in.
Yeah, so actually we have not exited any particular stock as such, but I think where we find that on a relative basis, if we find that something has been fully priced, then we are happy to start selling those and start getting into new ones. So, I mean, I think in terms of where we are looking, clearly banking has been a sector that we have been interested in. And, a new stock that I will say, though we have not necessarily bought it, but we are researching right now is Federal Bank. I think I saw that you will have Maniam later in the session, and he recently presented the approach of the bank and how he looks to grow the bank and define his new strategy for the next few years. Coming from Kotak, I'm sure he will add a lot of value to the bank.
Okay, all right. Hi, Rajiv. Good morning and good to see you. And Rajiv, what about your interactions, with all your clients and other foreign money that you manage? What is your sense? Suddenly China seems to be back in the game. Till maybe a few months ago, India was the only game in town. How do you see things shaping up? What's the kind of interest levels for the Indian markets? Because suddenly mood has got very, very somber out here. From being the only game in town, it appears we're not top of the pops. Tell us.
Yeah, no, so you're absolutely right, Nigel. I think earlier China was becoming uninvestable. Now, as I talk to many people, they're saying, well, China is so cheap that we can start wading back into the Chinese market. And I think some of the earnings results from some of those tech companies have started doing well. So clearly China, people are starting to wade in. On the India side, on the other hand, the earnings were quite weak in the last few quarters, as we all know. And so given the valuations and given where the earnings are, those are the two reasons which I think has caused people to pull out from India and start looking at China. The other thing, which is definitely a big factor, is that US yields have been elevated. And so I think there is a lot of money that was coming into the US and coming out of all emerging markets. But I think within emerging markets, there is this rebalancing that is going on.
Well, a lot going on, right? And I think we'll have to wait it out. By the way, I don't know, on Friday there was an executive order which was signed in the US. It kind of got missed. It's called America First. If you parse through it, it's really detailed. The scope is vast. It's all mostly directed towards China. Limiting their investment in US, things like limiting investment in US farmland. Passive stakes are okay, no majority control, no board seats, and it's very sweeping. And on the other hand, there are sort of publications like the New York Times talking about a trade deal, broader trade deal with the US, which then makes you think, well, are they softening their stand? So it's up in the air in that sense where this is really going to go. But Rajiv, it's a pleasure. Thank you very much for joining us and appreciate your time here on CNBC TV 18. Thank you. Well, I think let me just quickly run you through what's coming up here on the show over the next 2.5 hours. Corporate interactions coming up. So at 8:30, you'll get you excerpts of our exclusive conversation, as Rajiv was pointing out, with Mr. KVS Manian, MD and CEO at Federal Bank, and what his plans are for the bank. At 9 a.m., we'll have Manik Taneja of Access Capital to talk about the key trends in the IT sector. 9:20, Venugopal Manga, the HSBC Mutual Fund, is a market march of the day. 9:30, we have the management of Jupiter Life and Narayana Health, who will be talking to us about the impact of all the new entrants in the hospital space. Neeraj Sharma of OneSource Specialty Pharma will be speaking with us to discuss the outlook going forward. Their demand trends a little later. 9:50, Charlie Dutton of Manu Life Investment Management talks to us about the key trends in emerging market flows. So that's a market conversation. And of course, towards the end of the program, 10:15, we get chatting with Cyril Schroff, managing partner at Cyril Amarchand Mangaldas, and Raj Balakrishnan, who's with BofA Securities, co-heads the investment banking practice there. We'll ask them, despite the recent weakness in markets, is the trend of foreign MNCs coming to India to list going to continue?
Time to slip into a short break. We've got a lot of stock-specific action tracked for you in our special Top 10 segment. For the time being, I give you a sneak peek into the list. United Spirits, Indian Overseas Bank, Central Bank, Punjab and Sindh Bank, LIC, New India Assurance, Biocon, Axo Nobel India, and Campbell & Fine. All of them will be reacting to positive news flow, while SBI Cards could be reacting to negative news flow. Slip into that break, come back. We'll get into further detail on all of these names.
Welcome back. Our research team is now standing by with CNBC TV 18's list of top stocks to watch for the day. Good morning, everyone. Abhishek, let me start with you on SBI Cards. Why are we watching?
Well, credit card data for the month of Jan 2025 has come out from RBI. With respect to the industry momentum, total cards is up 0.8% YOY and about 9.5% month-on-month. So card issuances have been pretty strong. However, the spends are down 2.1% YOY and they are up 10.5% month-on-month. So average spend has declined nearly 2.8% YOY and is up about 1% on a month-on-month basis. For SBI card, the total card is up 1.2% on a YOY basis and about 10.1% on a month-on-month basis. However, the total spends are up only 2.7% YOY, but they are down about 5.5% on a month-on-month basis. So average spends for them is up 1.5% YOY, but they have declined massively by 14% plus on a month-on-month basis. So if you take a look at the market share of SBI card on total cards, it's up to 18.8% versus 18.7% on a YOY basis and about 18.74% on a month-on-month basis comparison. Spends market share has declined massively on a month-on-month basis. It's down to 15.7% for the month of January versus 15% that they had on a year-on-year basis and versus 18.4% for the month of December. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. So we'll keep an eye out on SBI Cards. Well, let's hop across to Timsy. She's here to tell us about United Spirits. Timsy?
Well, yes, as you mentioned, United Spirits is under watch, keeping the movement that we are hearing from sources on whether government could extend the similar duty concessions that it has offered to US-based bourbon whiskey to UK's Scotch imports, that is reducing the duties from current 150% to 100%, which would mean 50% of BCD plus 50% of agri-infra development cess. Currently, discussions are on, and soon a high-level meeting is expected at the PMO, including representatives from MEA, from Finance Ministry, Commerce Ministry, etc., to be part of these discussions to see whether this deal on imports of Scotch can be sweetened from current 150% to 100%. So that's why the stock is under watch. All of this is source-based information, so let's see how soon the meeting begins, or when is the meeting actually, and what is the final deal to close as part of the India-UK FTA talks.
Thank you, Timsy, for that. The market seems to like it. United Spirits closed at the day's high yesterday with a gain of nearly 3%. But Abhishek is back with us for the latest on public sector banks.
Rima, to begin with, government has invited bids for appointing lead managers or, broker, merchant bankers, etc. for the stake sale in selected, PSU banks as well as financial institutions. So, government has proposed a PSB divestment is what we have learned from, sources. They have requested for proposal for appointment of merchant bankers to deal with offer for sales. Now, the plan of government is to dilute about 25% stake in PSU banks as well as listed financial institutions, and this is at preliminary stage right now. So likely candidates for this would be IOB, that is Indian Overseas Bank, Central Bank, Punjab and Sindh Bank, as well as UCO Bank. Also on radar, New India Assurance and LIC could be on radar, given the fact that they also need to meet the 75% requirement norms that SEBI has for listed entities. Back to you.
All right, Abhishek, thank you very much for that. More stocks with news flow. Hormuz is standing by with that list. Hormuz, morning.
Morning, Prashant, and a couple of names on the radar pertaining to the M&A. But before I get to that, Biocon is one of them. They've launched, Biocon Biologics has launched the Yesintake biosimilar in the US, and that is used in the treatment of Crohn's disease, the ulcerative colitis and other ailments. So it's a positive development there. Expect the stock to open in the green. And a couple of M&A announcements, as I just mentioned. AkzoNobel is one of them, which has approved the sale of its powder coatings business and the R&D center to its parent entity. It will be done for around 2,000 crores, and they'll seek shareholder approval for the same in the coming weeks. And additionally, they'll also acquire the IP rights of AkzoNobel's Coatings International BV, and that will be done by the Indian entity, and that will be done for a consideration of 1,150 crores. It's a procedural step for the trigger, the main trigger, which is the sale of its decorative paints business. So we'll see how the stock reacts, mostly in the green. And Camlin Fine also has announced the acquisition of a 100% stake in a company called WinPi. And they're going to invest around 3.3 billion euros initially through the subscription of the illisted secured convertible bonds, and they'll execute a mandatory tender offer, is their word for an open offer, I guess, and that will be for 3.6 euros a share. So an acquisition from Camlin Fine, expect the stock to open positively as well.
Okay, all right. Thanks a lot for that, Hormuz. Here's a quick recap of all the top stocks we just ran you through. The ones with positive news flow: United Spirits, Indian Overseas Bank, Central Bank, Punjab and Sindh Bank, LIC, New India Assurance, Biocon, AkzoNobel, and Camlin Fine. All of them will be reacting to positive news flow, while SBI Cards will be the lone stock that will be reacting in the red. That's about all the equity market action, but for the time being, let's take a bit of a break and turn our attention to the commodity markets. Manisha Gupta joins us to tell us what's going on there. Morning, Manisha.
Morning, Nigel. Thank you for that. Well, I'll start with the gold prices, which are trading very close to its all-time highs. And we have seen the global tariffs lead to safe haven buying. The concerns on inflation also seem to be supporting prices. And the fact that the global ETF and the Indian ETF buying in sense of gold continues to be very, very strong. We've seen an all-time high in sense of net inflows in gold for the month of Jan, and the markets believe that Feb could be no different. What we haven't, the same strength is not what we are seeing in other metals. Silver prices fell a percentage point overnight. Copper prices are now trading at a 2-week lows. There is rising supplies in major trading hubs, and there's overcapacity in China as well, which seems to be putting pressure on prices. A quick word on crude oil prices, and after a 2.7% decline on Friday, Monday has seen some gains. So the overnight market's working with some bit of a positive cues right now. The street is looking at sanctions on Iran crude oil, and that is the latest trigger for these gains in the prices.
All right, Manisha, thank you very much for that. commodities there with Manisha. We'll take a quick commercial break here. We're going to come back. Amnish Agarwal of Prabhudas Leather is going to be with us with some stock talk that's coming up right after this break.
Welcome back. Hope you're having a good morning. Well, as promised, let's get straight to the big exclusive today. Federal Bank MD and CEO Mr. KVS Manian, in his first interview after taking over, unveils the plan for growth. Speaking to Shireen Ban, he says that the bank will be using the existing network to increase profitability and pace branch openings. Here's an excerpt of that conversation.
Well, let's talk about hitting the road running then, and the focus areas that you've identified as part of your growth strategy, Breakthrough 4.0. And you've probably also seen, as I have, the analyst reports that have come in after your analyst meeting, and while everyone agrees with the direction that you are taking as far as growing the bank is concerned, there are questions and some concerns on the execution challenge and whether the targets that have been set, for instance, on return on assets and so on and so forth, are too ambitious and doable. How do you respond to that?
So, Shireen, in fact, I clarified in my presentation there that those exact numbers are not important, right? The direction is important, one. Two, if there is a sectoral deflation or inflation of those matrices, obviously the point we were making is there is best three and next three, and we should lie somewhere in the middle of that pack. The parameters by themselves may change a bit here and there, but the idea is to lie in the middle of that pack, and that's the ambition. Just now, on some parameters, we may already be somewhere in the middle. Right. On some, we are behind. So the idea is to catch up with that. So that is one. So just to clarify, the absolute numbers are important, but you have to see it in a context. Yeah, they are not set in stone, and you have to see it in the context of the industry overall. Second, like I mentioned earlier, that yes, there is an aspiration built into it, some stretch built into it, yes. But I think the vision needs some stretch, and I am sure that team I have owns it. All the stakeholders that I have discussed the plan with are keen that we put some amount of stretch in the plan and go for it. And the confidence that the team will measure up to it is what is driving us.
So let's talk about the stretch that you speak of, and you said that people are on board with stretching yourself. The question that analysts are asking is, what will this stretch entail in terms of OPEX, for instance? I mean, how much do you intend to stretch yourself on that front? Right. Investments.
Right. So, we are not a bank which has a very comfortable cost-to-income ratio, as you know. I mean, we are at about 52-53%, and I would say I have relatively low wiggle room on stretching that too much. So, therefore, we'll have to follow a strategy where we grow our revenues and put on costs in tandem. We'll have to pace them reasonably equally, right? I can't just put all costs in advance because, like I said, 53, I can't stretch it too much. So, and I do think there are levers that we can use to push our revenues as we add on costs. And of course, to some extent, this is a 3-year plan, and we will pace ourselves in a manner that we keep control of our parameters and do not run away with too much investments in the beginning in the hope of getting revenues. We will balance ourselves.
Well, yes, so more restrained in terms of the kind of spends that you envisage. Yes. But if return on metrics is one of the aspects that you're focusing on as far as this plan is concerned, let's talk about some of the levers that you intend to exercise. And talk to me about what you intend to prioritize. One, of course, is the aspiration of becoming a universal bank. When you talk about expanding the franchise, for instance, what can we expect in the next 3 years realistically? You talk about 400 to 450 branches being added on. That's more than you've done in the decade gone by for Federal Bank. Right. So, prioritize for us what you intend to focus on.
Right. There is core part of the business and there is the universal bank ambition, right? So obviously core part of the business gets priority over the universal bank ambition. So in terms of prioritizing, that is one kind of prioritization. Second type of prioritization is, like you said, about the growth in branches. Obviously, we are not going to do in the first year out of the 400, 450, we will pace that slightly relatively more back-ended than front-loaded, right? We don't want to, for the reasons I already told you, that I don't want to change the cost to income dramatically initially. So I also feel that there are enough levers. For example, I have talked about it in my strategy. Our current account business, I would say if you take our CASA ratio, the broad breakup is 24-6, right? 24% SA and 6% CA. I would say
you're making it sound almost musical now.
The 24% SA is not is fairly in the right zone vis-a-vis the peers, right? More or less, give and take here and there. The 6 of CA is where our difference is, and that's the opportunity. Even within our given network, our SA can be higher without any further investment. Just doing better focused work, we can get outcomes on that. So there are areas like that where we will prioritize to get, juice the network more, to get some higher profitability products like CA is something that we can do without adding costs. So obviously, therefore, that is higher priority. So I would say even in core, our priority will be to attack opportunities like that. For example, we are in the car business.
Right.
Can we do used car business along with that? We can. It doesn't require much investment, right? It requires just the focus to get it done. You have a base which you have done business with. Can you do that? It increases our yields and it increases our returns. It gives us more leg room, wiggle room for taking costs. So there are areas which are clearly identified in that plan, if you look at, which do not necessarily need investments. Yes, branches do need investments, but there are lots of areas which we'll focus on to make sure that we create more revenues as we go along and then incur the costs in parallel.
Speaking of creating more revenue opportunities as well as new lines of business for the bank. Now again, plenty that's been highlighted there as potential opportunities that you're willing to look at. But will it be, if I would ask you, will it be buy versus build? What makes strategic sense to you at this point in time?
So I would say it's a mix of the two. In the core areas, I think it will be relatively more continue to build because there we have the skills, we have the distribution, we can still build without having to buy. There are areas where talent is required. Those are areas where I would say somewhere in the middle, build or buy. And there are areas where clearly which are outside the core strength of the bank. Let's say we talked about the universal bank area. Let's say if we have to think about as a universal bank in terms of brokerage or AMCs, these are completely different skill areas. So yeah, so there will be
that's likely to be the area where you consider inorganic opportunities.
Yeah, having said that, inorganic is my later priority. I would initially build core areas, get the bank on a stronger footing, create a better currency of the bank, and then look at inorganic. But yes, in principle, what you're saying is right.
And you can catch excerpts of this exclusive conversation with Federal Bank's MD and CEO all day today only on CNBC-TV18. We will get into a short break. On that note, on the other side, we'll connect with Amnish Agarwal of Prabhudas Leeladhar Capital for some fundamental stock talk. We'll also be joined by Sudarshan Sukhani and Mitesh Thakkar for some technical trades.
Welcome back. Well, let's get further fundamental analysis going on all the stocks that we discussed. Amnish Agarwal, the Director, Institutional Research at Prabhudas Leeradhar, joins us on the show. Hi, Amnish. Thanks a lot for joining in. I believe that y'all at PL are doing a lot of calls with a lot of investors, your clients as well. And I think in that call, y'all highlighted a few positives that could flow in with regard to the capex spend, the consumption boost as well, and this entire religious tourism that could aid the economy in the coming few months. That said, let's discuss a few stocks. SBI Cards, they have come out with their update. And I'm looking at a Morgan Stanley note. They're saying that the spends actually for SBI Cards is up, while for the industry it was down. And also on a month-on-month basis, there is some market share gain. Though on a year-on-year basis, their market share is still down. What's your view on SBI Cards? One of those stocks that didn't participate in that big bull market run that we saw. Your take?
You see, we don't have a formal rating on SBI Cards, but as per our understanding, two things can happen for SBI Cards. One being that if you look at the industry as a whole, while the overall transactions in their credit cards, they are going up. But the spending per transaction, that has been going down, which might be an indication of the slowdown which is there in the economy. So that is one. The second aspect in SBI Cards is that once the interest rate starts softening, then I think there will be some tailwind which will come to this company as well. So to that extent, I think that once you can say the interest rate, they start softening and the demand revives, there could be some tailwind which will come to the credit cards industry. And SBI Cards will also gain by virtue of that.
Amnish, hi, morning. The government looks keen to push through divestment for some of the PSU banks, the DPAM, that's the Department for Investment Banking, etc. They have empaneled investment bankers to look into it. And some of the banks where the government, holding is close to about 90% is IOB Central Bank, Punjab and Sindh Bank, or UCO Bank. So these become likely candidates, for the government to offload their stake. Will the street get excited with this development?
In the current context, when the markets are under pressure, I think the streets might not get excited due to this. Now, there's another reason. If you compare the PSU banks with the private banks, there is one clear differentiator as far as your CET1 is concerned. Because in case of the PSU banks, the CET1 is, you can say, at least 3 to 5% lower than what it is there for most of the leading private sector banks. So they eventually would need money. That is one aspect. The second is that once a bank mergers happened and a lot of these NPAs were taken out of system, at that point of time, most of these banks, the government stakes went up drastically. So now they also need to cut stakes in many of these banks. So the divestment will happen, but I don't think there is anything very exciting going around that, because the PSU banks have also been massively re-rated over the last, say, couple of years in particular. And from here on, the incremental re-rating doesn't look likely for them.
Someone was saying that PSU banks are cheaper, much cheaper than private sector banks still. But maybe the larger trend is still the fact that private sector is gaining market share, right? That's the overall sort of picture, the larger story in that sense. Amnish, good morning. Good to have you with us here. Just a quick word on a Federal Bank. I don't know if you heard the conversation with which my colleague Shireen had with KVS Manian. There was an analyst meet as well. They put out some targets in terms of what Mr. Manian wants to do with Federal. Any thoughts?
You see, they are all very longish term targets, something like you can say to be among the top 5-7 banks over the next few years. You see, there I would say they are quite well placed. But then to achieve those targets, it will require massive amount of execution. And execution is where federal banks were lacking, you can say, in its earlier avatar. So I think at present, I think it seems to be reasonably well placed. That is one. The second is that if you look at, say, the overall scenario, the main aspect to be looked into it will be the execution. If they're able to execute well, then I think there could be, you can say, a lot of ground which this bank can cover over a period of time.
All right. From banking to FMCG, consumer, right? My colleague Shilpa spoke with Suresh Narayanan, Chairman and Managing Director at Nestle, and asked him about the demand in urban consumption, if there is any sign of pickup. Also outlook for FY26. Listen in.
I don't, as a company, give any forecasts on what we will do. I can only say that I think volume growth has started to happen, which is critical for the consumer goods space. Whatever value we report is based on, pivoted on volumes. That has started to happen. Is this a secular trend? I think we'll have to wait for a while, but it is at least positive signs have started to come.
Positive signs have started to come. Amnish, any thoughts on the space? Anything you like within staples?
You see, as the inflation, particularly on the food side, it has started softening, I think eventually the demand for FMCG products is going to improve and the volume growth will come back. But having said that, if you look at many of the larger players on the FMCG side, it is not only the current pressure in demand from the past, let's say, a few months, which has been impacting, but there are structural issues with several companies with regards to competition, with regards to their product mix and various other aspects. So there will be an uptick in demand, but structural things, they are not going to change. So in the staple space in particular, we currently are liking one is Britannia, where I think that they are much better placed than most of the other players as far as your competitive intensity and other your business modes are concerned. And I think at the current valuation and the price of around 400, I think ITC also looks interesting unless and until there's a big hammer in terms of, say, duties and taxes, which comes from the government side.
Amish, the other story that we've picked up, and this is a CNBC-TV18 exclusive, is that the Indian government is now considering a review of the import duties on alcoholic beverages, particularly Scotch whisky, which comes from UK. Basically giving the same kind of concessions that you are giving bourbon whiskies coming from United States. So it could be positive for United Spirits if it comes through. If this plays out, how big a positive would it be? Would you look at United Spirits in particular?
It's very difficult to quantify, but having said that, your imported branded whiskies, or you can say the products which come under the bottle in origin kind of a stuff, so they have been attracting much higher duties. Now, if you look at United Spirits in particular, so they have been gradually increasing the proportion of the sales, and they have cut back on the tail significantly over the years. Now, the consumer class which uses these products, they are all, I would say, upper middle class, or you can say the premium end of the consumption. But if the prices of these come down, I think there could be a significant boost to both sales as well as profitability of many of these companies which are importing these products. And I think United Spirits, because they are now handling the entire global Diageo portfolio of whichever brands are being sold in India. So I think definitely this company is going to benefit out of it.
Okay, all right. Avnish, I wanted your view on some of these metal-related companies as well. Getting into the weekend, I got a lot of calls telling me that, Nigel, that duty is coming, and it didn't come. So yesterday you saw a knee-jerk reaction. A lot of these stocks did see some selling. But the industry believes there's a very, very strong case that we see some kind of protection from the government of India because of the way China has been dumping steel all across the globe. And now if the US puts additional tariffs, that could lead to further dumping as well. So in that case, it could make the domestic steel companies' plea rather stronger. Your view on the Ferris names first?
The news which you talked about, or you can say the rumor that has been doing the round in the media from quite some time, that eventually the duties are going to come. And yes, exactly, with the US now increasing the duties on you can say Chinese steel and other metals, I think the flow to other markets will increase. But this is also a reality. If you look at US, their maximum imports comes from not China, but some of the countries like Canada and Mexico, and China directly accounts for only 6%. And what happened last time around was that once you increase the duties on China, the Chinese goods are actually flooding the US markets by getting it rerouted from the countries where there was some concession. So I believe that it is not only I would say the US markets which will be at play, it will be you can say the overall pressure which is there. But yes, there are hopes that the safeguard duty is going to come in case of steel, and not only steel, I think many more commodities will qualify for that. But usually it is very difficult to take a call that whether it is going to come, when it is going to come, and what portion it is going to come. But looking at the past history where they had imposed the duties on steel earlier also, one can have a fair expectations. But the timing for that is very difficult to watch.
One more stock you should watch today is Bharti Airtel. The stock closed down close to about 2.3%, and there are reports which suggest that the Tatas and the Bharti Group are finalizing a merger between their D2H business, direct-to-home business. So basically, Airtel Digital TV and Tata Sky, which has now been rebranded as Tata Play. So that's another stock. This is what reports are suggesting. CNBC-TV18 has not independently picked up the news or verified it, but that's a stock you should keep your eye out on. Amnish, lots of news flow surrounding Bharti. First, promoters selling stake in the Indian arm Airtel Africa, then Bharti Airtel increasing their stake in Airtel Africa, and then this news about D2H. And D2H has been struggling because of the way streaming has picked up across OTT platforms. Where do you stand on Bharti Airtel?
D2H is not a very, very big part of the overall valuations or the SOTP of Bharti when you do. Now, if you look at D2H as an industry, I think it has already peaked out both in India as well as globally. And as the, you can say, usage of data improves and as the streaming services pick up, there is no, I would say, big growth driver which is left for the D2H industry. And consequently, I think players usually merge down because Bharti is also, I think, gradually moving more and more into the streaming, more like what Jio has done. So I think that eventually seems to be the way forward. But Bharti is more a play on the data, more a play on the overall telecom. And I won't say that this D2H merger is going to make any big change to the fortunes of Bharti. But structurally, I think it seems well placed. The next few quarter numbers are going to be really good for Bharti because the carryover impact of the last year's price increase that will continue for some time. And I think as we go along, I think telecom it's more like a consolidated market, and I think Bharti seems to be even very well placed even now. I think it will continue to give you secular returns from here on also.
All right, Amnish, we'll take a quick commercial break here. Allow us to do that. We're going to also be joined by Sudarshan and Mitesh as we track market technicals and some trading ideas as well. Stay tuned, coming up.
Welcome back. The GIFT Nifty this morning is suggesting a flattish start. This is after the Nifty yesterday closed at an 8-month low, but managed to close above the 25,500 mark. The GIFT Nifty right now, the implied open is down 21 points, but the picture across Asia is still quite sour. Most of the Asian markets reeling with the cuts. Mitesh is now with us for a few technical trading ideas. Mitesh, morning. First, the call on the Nifty and the Nifty Bank.
Good morning. See, I think last few days, couple of days back, we were all talking about the multiple times Nifty was taking support at 22,800, 780. I think having, violated that level and trading below that now means that unless that level is captured again, one should not look at some kind of upward movement in the index. So till 22,800 is crossed, I think, I would believe that this is a market which might get sold on rallies, and then we need to figure out what are the possible downside targets. What I can see possibly is that we might test 22,250, or in a more slightly bearish scenario, 22,050 to about 22,000 as well. So I think the market still remains slightly biased on the negative side, and the only reversal sign will come in case we start closing about 22,800.
Okay, all right, Mitesh, what about individual stocks?
Good morning. So I have a mix of buys and sells. A buy on Berger Paints, and it did very well yesterday in a declining market. It's given some kind of a reversal. So buy here with a stop at 492 for targets of 520. Similarly, ABB looks to be reversing from extremely oversold levels, slightly riskier call compared to Bazaar, but I still believe that there's a good chance of the stock bouncing back to about levels of 55.50 and recommend buying here with a stop at 52.75. A sell on Ambuja Cement with a stop at 479.5 for targets of 450. And a sell on Bharti Airtel on a mild pullback. So let's say around 1608, 1610. Sell with a stop at 1625 for targets of around 1577, 1575.
All right. Gentlemen, good morning. Sudarshan, how would you look at things this morning? I mean, again, a disappointing day yesterday, and of course, backed by very large sell figure from foreign investors. Price action first, and then we'll get into trades.
Sure. See, the price action continues to be the same that we have been seeing for the last many days. Even small rallies are getting sold into, lower levels are being bought, are being visible. The Nifty is breaking lows, so we are having a clear pattern of lower lows, lower highs. That doesn't change in half a day. Unfortunately, even for intraday trades, I don't see a very big opportunity or any opportunity on the long side. In fact, the Nifty is an avoid as it has been for many days. The Bank Nifty may be a short selling opportunity only for intraday trades, not otherwise. So the index trades are very limited. Avoid the Nifty. See if you can sell into a rally in the Bank Nifty and focus on stocks. And here is my stock list. Because I am also slightly bearish and downbeat on the Bank Nifty, I have two intraday shorting ideas, both banks. IndusInd Bank is an intraday short with a stop above 1055, and that big bank, ICICI Bank, is also suggesting some weakness. Consider an intraday short with a stop above 1240. I have two buy ideas. You know, buy ideas have to be positional. They cannot be intraday in this market. But still, they're worth looking at. NTPC is a buy outperformer, buy with a stop under 310. And Jubilant Foods may be coming out of a correction. Consider buying that with a stop under 640. Two buys, two sells, avoid the Nifty, short selling in the Bank Nifty.
Okay, all right. Thanks a lot for that, Sudarshan. Well, let's get back to our conversation with Amnish Agarwal. Amnish, yesterday we had NTPC green because of that lock-in period expire. The stock actually was down. I recall the stock, the IPO was at around 108, if I remember correctly. It went dancing away to around 150, and yesterday it closed sub 100. That's a big correction from the recent peak. What's your view on this name, or the entire theme, the renewable energy theme? Do you like something out there?
You see, the renewable theme is here to stay. Now, NTPC Green in particular, I think they have big expansion plans going forward. And I think technically now the stock has come below where the IPO levels were. In terms of numbers, I think as of now, there is nothing which is very meaningful from NTPC Green, and it is only over the next few years that the numbers will start improving for NTPC Green. Renewables is a good space, particularly as of now. If you look, the action has been more on, you can say, the companies which make solar modules, which do some kind of an EPC work. But eventually, on the generation side, we have got JSW is there, then Adani Green is there, NTPC Green is there, and NTPC in terms of capacity is smallest among all the three. So I think if this, you can say, the pressure of selling takes the stock down to, can take the down to more lower levels because of the kind of pressure which is there in the markets, then I think the overall renewable space in the long term looks interesting, and NTPC Green actually will also be quite an interesting stock to watch out for.
No, I mean, a huge amount of capacity addition has to come on board. There is absolutely no doubt about that. I think 500 gigawatts by 2030 renewable capacity. We are at about 200 odd. So there's a lot more capacity addition, a lot more funding, etc., which needs to happen in that particular space. Amnish, in the IT services space, anything coming up on your radar?
The IT services, if you look at, say, last year or so, it has been more like, you can say, the hopes have been there that the things will turn around. Eventually, the growth rates will pick up. But we need to look at two aspects. Now, in the near term, there could be some gains because of rupee depreciation. That is one. Secondly, Europe still continues to be under pressure, but India is more like, I would say, US-centric. But even in US, I think if eventually the duties which the Trump administration, they plan to impose, it plays out, and overall there's some pressure which builds up on the demand side and all, then I think the expected recovery in many of the IT stocks, it might not happen the way people are expecting. So in IT, I would say would be very selective, not many names to choose as far as I basically won't go aggressive in buying the IT stock even at this point of time.
All right, Amnish, we'll leave it there. Thank you very much for staying on and answering all those questions. Appreciate it very much here. JP Morgan CEO Jamie Dimon says that if tariffs are implemented by Trump, and if tariffs as an instrument are overused, it could be bad for the global economy. Also called the US government inefficient. Said that Elon Musk's Doge efforts need to be done. Listen in.
I think the economy is like this huge ship of state, and these things are at the margin may not change that ship of state. And also, it really depends the quality of what they're done. More effective government, more efficient government isn't bad. It's actually a good thing. If they get overdone, tariffs properly used. If they're overused, if there's retaliation, yeah, they could be bad for the economy. But they're just making up for use for negotiation, just making up for unfair trade. So I'm more in the wait and see attitude about how this all plays out. The government and everybody would know the government's inefficient, not very competent, and it needs a lot of work. And so you and I, it's not just waste and fraud, it's outcomes. Why are we spending the money on these things? Are we getting what we deserve? What should we change? So I think doing that needs to be done. Remember, it was tried by Al Gore and Bill Clinton. It was tried by a bunch of other folks in the past. Yes, they should try. You have to understand that whenever you go to any big institution or the government, the bureaucracy pushes back on everything. And they will hear every little thing they're going to push back on. So you have to be strong if you're going to do it. I'm hoping it's quite successful. If there's overreach, things they're doing which are not legal, the court should stop it. But I'm hoping that's not the case. But again, it's very early stages to tell exactly what it's going to mean and how it's going to affect the economy.
Well, in pre-opening, it's a mixed start. The Nifty is currently down close to about 100 odd points, but we'll wait for the rates to settle. Sensex is up in the grain, and that perhaps just up close to about 0.2, 0.3%. But again, waiting for these rates to settle. Let's put the spotlight on the IT sector. Yesterday, the Nifty IT sector was the worst performing index, down close to about 2.7%. Year to date, the tech index is down nearly 9%, and there are concerns that US tech spending on capex will come down, and therefore that could hurt the Nasdaq, and maybe there could be a spillover effect on Indian IT too. We have with us, and even at yesterday, of course, the NASSCOM summit is ongoing. To talk more about the IT sector and the outlook, Manik Taneja, Executive Director, IT Services and Internet at Axis Capital, is now with us on the show. Manik, over the last couple of days, we've seen Indian IT stocks correct. Yesterday, in particular, large, these mid-cap IT names like Persistent, Coforge, which have had a one-way run, have corrected even more. So what's happening? What's dented the sentiment in the last 1 week on IT in particular?
Good morning, Teema. I think a whole host of factors at play over here. And even after the recent correction, Nifty IT is still outperformed Nifty over the last 6 months and 12 months basis. The stocks that have been correcting more sharply are the mid-tier names, given the punchy valuations that they've traded at, and some amount of disappointment with the way some of the global tier 2 techs have reported over the course of last couple of days. So we had the likes of EPAM, Globant, and Endava report on Friday. And while the qualitative commentary essentially remains quite positive, similar to what we've been hearing from Indian IT, signs of green shoots related to North America markets, as well as verticals like financial services as a whole, which is very similar to what you've been hearing from Indian techs. I think the rate of change improvement is where there have been some disappointments. So the likes of larger companies like Cognizant as well as CAP, the extent of improvement that I'm talking about in calendar year 25 is about closer to between 200 to 300 bips on a year-on-year basis. While in case of tier 2 techs, there is improvement for the likes of EPAM. Globant is talking about a similar kind of a growth in calendar 25 versus calendar 24. So some of those aspects also feeding in terms of realignment that we are seeing for Indian tech names. And as I said, tier 2 techs are the ones which are seeing much sharper correction. They are the ones who traded punchy valuations and are hence correcting much more.
Coforge is trading at 36 times forward multiple. Persistent is at 51 times, and it's still at a premium to the 3-year average. It's at about, Persistent is trading at a 33% premium to the 3-year average despite the recent correction. So what are investors telling you right now when you speak to investors about the outlook on Indian IT? Because the picture, I mean, on growth front, at least things are looking a little more encouraging. FY26 could be better than FY25. So, how do you marry the growth versus valuation argument when you speak to investors?
No, so that's a constant debate that people have been having over the course of recent months, given Indian IT continued to do very well through most of calendar year 24 and where valuations have remained much more expensive compared to historical levels. Global tech services names in particular trade at discount to their historical multiples, trade at discount to Indian IT. So a lot of folks have been trying to essentially understand, especially for investors who could play tech services listed globally. They've been debating on this relative bets. Global tech services through the course of last 3 or 6 months had outperformed Indian IT. Even some of the names that I spoke about, EPAM and Dava, which fell very sharply on Friday and even on Monday, and have now given up most of their outperformance in the correction in the last couple of days. People are still debating about the extent or the rate of change improvement in FY26. I don't think so. There is a lot of debate around the potential for companies to possibly get to flat to higher margins in FY26, but it's the growth acceleration that people are worried about.
Your top picks in the large cap space are Wipro and Infosys. Now, Infosys is likely to have industry-leading growth in FY26, given the low base of what we've seen. But Wipro, it's done a fantastic job over the last couple of quarters in terms of stability. Things are picking up. They increase the dividend payout ratio as well. But tell us a little bit more about Wipro, because valuations too have gotten re-rated.
Sure. So when we upgraded Wipro a few months back, we pushed it to the top of our preference order in the tier 1 space. And Wipro as a company tends to do well once every few years. CY17 was that year, CY21 was that year, and we would reckon that even CY25 would play in a similar fashion. So a combination of factors, portfolio mix, which is far more attuned to discretionary. Think about Capco, think about the rising assets. Both those assets are playing on discretionary spending pickup. In addition to that, you've seen Wipro do a phenomenal job in terms of defending margins despite revenue pressures, and the most recent move around resetting their capital allocation policy. I would say the rate of change for Wipro going into calendar 25 is also positive, and which is the reason why we put it at the top of our preference order within tier 1 peers.
And in mid caps, your preference lies with Mphasis and Zensar.
Yes.
And both these stocks have done well. So from here on, what do you expect?
I would say Mphasis, no. Mphasis hasn't done that well, and we upgraded just after the most recent quarter numbers, and stock has come off similar to other tier 2 names. But this is a name which is most leveraged to financial services, and some of the factors that worked against them through the course of last 24 to 36 months, in our view, will work to their advantage on a go-forward basis. And that's the reason for preferring Mphasis. And this is possibly, along with LTI Mindtree, maybe the only tier 2 tech stock which may be trading at close to last 3 or 5 average multiples. So valuations relatively far more sanguine, and the likely expectations of improvement in FY26 on growth for them. You saw the kind of deal wins that they reported in the most recent quarter. They were fairly encouraging and should provide support to the expectations of improvement for the company on growth in FY26.
And Hexaware Tech, have you analyzed Hexaware Tech? It's relisting now. It had a okay opening, but since then it's picked up to about 800 rupees.
So we don't have formal coverage on Hexaware, and thereby may have limited opinion on that front. But this is a firm which has done which has been far more consistent in terms of revenue growth profile, certainly underperforming the likes of Persistent and Coforge on growth through the last 5 years. If you peel through the onion, they've done very well in terms of diversifying the revenue base. Almost client concentration is next only to Coforge amongst their tier 2 names. And in terms of cash generation, partially because of the ownership, they seem to be fairly consistent. So I would say logically this is a name which should trade on par with some of the mid-tier coverage.
Manik, thank you very much for joining in with your thoughts on Indian IT this morning. Sudarshan is now back with us for the 9:10 call.
Yeah, consider buying NTPC with a stop under 310.
Mitesh? NTPC, got that. Mitesh, what would your 9:10 call be?
I'll go with the buy on Berger page for targets of 520.
All right, those were two trading ideas just as we begin trade. Pre-opening rates have settled in and now it looks more believable. Sensex flat, Nifty is just down close to about 0.1%. So quite subdued opening this Tuesday morning. Abhishek is now back with us for SBI cards.
Well, Rima, the credit card data momentum for this sector has come in from RBI for the month of January 2025. Now, YOY, it looks to be a weak growth for the industry as well. So, total cards is up just 0.8% YOY, but they are up 9.5% on a month-on-month basis. Total spends are down 2% YOY, but they are up nearly 10.5% on a month-on-month basis. So, if you calculate the average spend per card, it's down about 2.8% YOY, but it's up about 1.1% on a month-on-month basis. Remember that December month was also pretty strong for the credit card business momentum. So SBI card over there, the total cards issued is up 1.2% YOY and about more than 10% on a month-on-month basis. However, the negative surprise has come in with respect to spends. So spends are up 2.7% YOY, but they have declined 5.5% on a month-on-month basis. Average spend per card is up just 1.5% YOY, but they have declined more than 14% on a month-on-month basis. So spends, they have lost market share. Talking about market share, the total card market share for SBI card is at 18.81% when compared to 18.7% on a year-on-year basis and about 18.74% at the end of December. The spends market share has declined massively on a month-on-month basis. It's now at 15.7% when compared to 15% year-on-year and about 18.4% on a month-on-month basis. Back to you.
All right. Abhishek, thank you very much for that. There's, I think, about a minute to go for the market opening itself. Mitesh is with us. Mitesh, anything else you're spotting out there, and at least in the pre-open and how things are setting up?
Not much, Prashant. I think, the only worry is that the Nifty IT index, could get slightly tricky. It broke the 200 average on Friday, and then yesterday was a gap down with a big red candle. So I think next couple of days, IT as a space could be under pressure, but it's a subdued opening for today, so nothing much.
Okay, all right. A big crack yesterday as well as far as IT services index goes. And I think maybe part of the reason, of course, was that US services PMI number, which was a bit of a shocker, a first decline in a couple of years. Well, I think we've got the first rates which will start to appear on your screen. Anytime we look at the indices, then we'll look at the broader market, etc. So it's, neither here nor there. It's not decisive, but tentative. So 22,530 is on the Nifty. So a little bit of green, good to see. Nifty Bank about 0.25% higher, 48,800 nearly, roundabout there, about 1/3% higher in the Nifty Bank. The Nifty is absolutely flat, nothing on it. The mid-cap index is again flat, but not really showing anything meaningful up or down. And I think it's a more two-way kind of market, at least at the word go, with equal number of stocks which are higher and lower. But 13 points on the Nifty now, so 22,570 is what we have. Rima.
IT perhaps is again the sector which is under pressure today. The Nifty IT index is opened with a cut of about 0.5%, and now the Nifty IT index is down for 12th session out of the last 13 sessions. So it's been a one-way slide for Nifty IT over the last 2 weeks. TCS is down more than about 0.5%. HCL Tech lower by half. So that's a weak pocket. Top Nifty loser today is L&T. That's got a cut of more than 1%. You've also got cuts coming through in Hindalco, Titan, Tata Consumer, SBI Life, Sun Pharma. These are some of the notable losers. On the way up, it's M&M higher for the second day in a row. It closed up with a gain of over 1% yesterday on positive brokerage commentary. It's followed it up with another 1% gain. This week, it's seen in just 2 days up nearly 2.5%. Shriram Finance is also inching up, so that's looking up. Private sector banks are coming in for buying this morning. ICICI Bank, Kotak Mahindra Bank on the buyers list. ONGC, which fell yesterday more than about 2%, has rebounded partly. So it's a partial rebound on ONGC, a gain of close to about 0.2, 0.3%. Trend is making its way higher, getting noticed, up more than 0.5%. But I think it's M&M on the way up. Once again, 1.3%, and on the way down, IT is again on the back foot.
Well, that's right. A few stocks that are buzzing around. IRDA, because of that fundraising plan, that's up close to 3.5%. Some of these banking names on the hope of some kind of privatization, I think, as well, they are moving up. You have Central Bank of India, Bank of Maharashtra. Some of these smaller PSU banking names have moved up. Welspun Specialty, they have announced the rights issue with the dates as well. So that's one stock that's up close to 3%. Last few sessions, it's been moving from circuit to circuit. So Welspun Specialty is another one. Texmaco Rail, they've done a tie-up, with a Polish company, I think, if I remember correctly, Novoma Forge. So that's why that stock is up and about in today's trading session. So good move is what we're seeing on that one. Varun Beverages, after the big pullback that we saw in yesterday's trading session, stock is still down more than 20% for this year. But yesterday's trade, it ended high with a gain of close to around 5%. In today's session, it's giving some part of that up. And as Abhishek said earlier today as well, SBI Cards, he wasn't too impressed with the updated performance. That stock opens up soft with a cut of close to around
There's also a small dividend of 2.5 rupees. So it's also gone ex-dividend by 2.5 rupees. But I think the fall is a little bit more.
Yeah, a little bit more than that. So it's mildly negative if you take into account the point that Reema's putting about the dividend. Just one positive today is that the Nifty Bank, after a while, has made a higher high. Last 4 sessions, it was making a lower high. So today's high is better than yesterday's high. And since the IT index is a little bit off color, I think the Nifty Bank will have to take the mantle on for the bulls if we need to pull back from here on. Prashant.
No, absolutely. And, let's just hope that some stability sort of comes through. And it's not just like a bit of a holding pattern and then there's another big leg down which starts to appear, which has been the case. Last week was not bad actually, but this week so far has been pretty poor for those who were hoping that there will be some recovery. So 22,560 or so is where the Nifty is trading at. Maybe just a brief look at any other names with volumes which are coming up. Tata Investment Corp is one name which has actually got huge volumes for this point in the day. It's back up about 6.5%. So that's essentially it's like a private mutual fund, if I can call it. I don't know if that's the right way to describe it, but that's a Tata Group company, holds high quality stocks in the portfolio and invests their own money. Credit Access is up about 5.5%. So that's trying to recover a little bit. That's again an MFI name which has been sort of swinging between 800 to 1100 levels, but not being able to hold on to high levels. There is Hitachi Power India, which is up 2.5%, nearly just under 12,000 rupees right now. Z is up 2%, about 98, but it's got some volumes, and that's why I mention it right now. So that's it. Godfrey Phillips is up 1, KRN is up about 2, IREDA is up about 2.5%, 2:1. Almost exactly 2:1 advances to decline ratio at this stage. Let's get in our market master for today. We have Venugopal Mangat. He's joining us to take some questions. Venugopal, of course, is Chief Investment Officer, Equity at HSBC Mutual Fund. Venugopal, great to have you with us here. Good morning. Prashant this side. We spoke recently, and of course, even from there, markets have come off very sharply. It's just been a one-way slide. Broader markets, of course, still looking pretty weak. We had Gautam Dugat of Motilal Oswal yesterday with us, and we were just comparing long-term, what does the small cap and the mid cap indices at the index level trade relative to the Nifty and where they are now. So going by historical sort of gaps, it would seem that both the small cap and mid caps at an index level still hugely overvalued. If you just go and look at history, 20-year histories, Just your thoughts to begin this conversation there.
Yes, good morning, Prashant, and thank you for having me on the show. Yes, I think from a historic perspective, small and mid caps still look a little expensive, but I wouldn't say that it's just the small caps and mid caps that are expensive today. I think many of the large caps, including the IT names that you were speaking about just 10 minutes ago, and maybe even many of the other names, consumer names, are still expensive. So I don't think it's only the small and mid caps. The other thing that I would want to say is that we are in a structural expansion for the economy, and given the reforms of the last decade, I think the platform is set for the smaller companies to really grow much faster. And in that sense, for the next 7 years, as the economy is expected to double in terms of size from a 3.8 trillion to a 7 trillion plus by 2030, the landscape of the market is likely to change drastically. And by 2030, I would think that some of these small companies, especially in the discretionary space, discretionary consumption space, manufacturing space, etc., would multiply significantly over the next 7 years. So that's where the money is likely to be made. Even though the valuations look a little expensive as of now, that's the case across the markets, and you're seeing the correction therefore. So I think this is a healthy correction. We've already seen more than a 20 to 23% correction in the small cap index. Stocks have corrected 30 to 50%. I think that's a fairly strong correction in a good expansion cycle. My sense is we are getting close to the bottom. I think it's a good time to invest, much better than what it was maybe 6 months ago.
The high was made in September, so it's been quite a fall over the last couple of months, but we're closer now to the bottom. So at these levels, if one needs to construct their portfolio, tell us top down, how much would you allocate to financials? Because I see recently HSBC also launched a financial services fund. So how much would go into banks, NBFCs? Is that a space that looks attractive? Insurance? Make a portfolio for us if you have 100 rupees of incremental money to put to use right now.
Yeah, across the market, if I have to look at sectors, I think consumer discretionary is a space which is, like I just mentioned, is I think bottoming out. So many of the stocks that we were looking for, to invest over the long term, for a long period of time, are now coming to a reasonable level. We believe the interest rate cuts and the SOPs that have been given to consumers should benefit over a period of time with a lag. It should improve consumption trends. And therefore, that's a good segment to be in for the longer term. Of course, I'm talking about the next 3 to 5 years or even more, because we are long-term investors, and I think the opportunity is to invest for the next 5-7 years. Similarly, I mean, we've launched the financial services product. We believe strongly that the non-lending space is likely to expand significantly. The number of companies today you see in the market in the listed space within the non-lending part of the market is limited today, but I think over time that is going to increase. We've drawn parallels with what happened in the US market from the 1980s till now. The US GDP grew about 10 times from 1980. It was about $2.8 trillion in size. Today, it's more than $28 trillion. And during the same period, the financial assets have grown within the country, has grown more than 20 times. And we looked at the non-lending part of the S&P 500, the top 15 companies, and we found that those have grown in terms of market caps very significantly over the last 25 years in this century. Drawing parallels from that, I think we are in the starting phase of an expansion in that non-lending part. So I would definitely want to allocate money there for the longer term. Of course, stocks are correcting there. In the near term, I would agree with many others in saying that the banking space looks a little more attractive in terms of valuations. But there again, I think there are points that you need to consider before really taking a longer term view, given that the net interest margins are probably at a peak, and the asset cycle is at its the best in a long time, and credit growth is yet to pick up in a big way. So till the time you have confidence on the private capex cycle, I think credit growth is likely to remain sluggish, and the retail growth is also, the regulatory pressures are there to not grow it beyond the point. So in that sense, I think credit growth will continue to remain sluggish for some time, and the NIMs and asset quality is at the best. So I don't think you can really say that they are structurally, therefore, very attractively priced. But on a relative basis, yes, that's a space that looks better in terms of valuation.
Hi, Venugopal, and good to see you this morning. The other point from the banking as well as the financial names is the FI's largest holding is in these names. And they have been selling lock, stock and barrel. You thought 2024 was bad. Well, just take a look at the start of 2025. What's your view on this FI selling that we have seen? One would argue their holding is at the lowest we've seen in multiple years, but it's just not stopping. Yesterday, we saw close to $1 billion in a single trading session. Your take on this?
Yeah, I think the foreign institutional flows have gone against India and possibly against the emerging markets from September end. I think that's when the market started building in the expectations of Mr. Trump coming to White House. And I think with those expectations, the dollar index started gaining, the bond yield started moving up in the US, expecting inflationary pressures with tariffs and retaliatory tariffs. All of that, to my mind, has played out. And in this period, I think China has also been trying to revive and recover to some extent. I think there are some positive spaces there, and valuations are definitely more attractive against most other countries. In this period, we've also seen the Magnificent Seven in the US really put more money into AI, and a lot of noise around that, and that driving markets further. So I think against a slowdown in India and high valuations, probably the foreign investors are seeing better trends outside, maybe a stronger growth market in the US, maybe value in China, maybe some safe haven assets outside that. So that's probably what is playing out. My sense is the brunt of selling, or the larger part of the selling, is probably done. I don't think the ferocity with which the selling took place over the last 3 or 4 months will continue going forward into 2025. I think at some point, and my belief is the markets are likely to bottom out soon, and at some point the foreign institutional investors, given that they are so underweight against the index, will need to relook at India.
You did mention the US, etc., Venugopal. So my question essentially is, do you think the top is in for US tech? Simply, and if it is in and we see meaningful pullbacks, will it have an impact here in India?
I'm not an expert on the tech sector, but I think what I'm hearing from a lot of strategists also is that the spending that has gone into the IT space, especially for AI, has really peaked is extraordinary. And it may not result in the results that one is seeking. And to that extent, I think there could be challenges for that space. My sense is the valuations also overheated there, and very sooner than later, I think that market is also likely to peak out, in my view. But it all remains to be seen as to how the Trump administration takes this forward, and without challenging inflation, or without stoking inflation or impacting the growth in the economy, does what he wants to. The IT space, however, I think the AI is clearly the next wave that we are seeing across the world. So it will continue to be a buzzing space. The stocks there have become expensive and have done extremely well. So maybe you could see a peak soon.
All right, Venugopal, thank you very much for joining in. We'll continue chatting about the markets, focusing on emerging markets, the kind of selling we've seen from FIs in India in particular. Charlie Dutton, head of emerging markets and Manulife Investment Management, is now with us on the show. Charlie, thank you very much for joining us in the studio.
Thank you for having me.
Well, so the first question is this selling spree by FIs. Is money moving out of India into China? What's driving this kind of selling pressure that we've seen?
So it's a very interesting question. I think when we're looking at this at the moment, it's very much not a case of India into China. It's interesting to see that the large amount of the China move that we've seen so far year to date, and certainly into the end of last year, was very domestic driven. So international investors have not really been moving from India to China. When we're looking at India itself, I think the selling pressure here really has come about from the tremendous bull market which we've had in India over the last 3 years. And as we went into the end of last year, valuations on India became stretched. So all it took was a slight slowdown in the credit markets, in the credit cycle, in loan growth, and some earnings expectations, and that led to money coming out of India. I certainly don't think the bull case for India has changed, but I think with all long-term bull markets that you have, and that's what we believe is happening in India, you will get these pullbacks and a reset, and I think you'll see a return of FII, certainly in the second half of the year, once those valuations get back to those long-term averages.
Okay, all right. Hi, Charlie, good to have you, and good to hear that, in terms of the FII, it appears that valuations got a little bit excessive and earnings growth didn't pick up. So you're expecting the FII flows to return back to India. What do you think in terms of, this argument about India versus China, though? As you've said, is the money is moving out of India, but it's not moving into China.
Yes.
Do you think that in their pecking order now, given the valuations of China, given the moves that they've made, in terms of tech, in terms of the way they're producing their cars, even the moves they made in the pharma space, do you think that China actually is now the game in town, because still last year, India was the only name in town that we're looking at. It was the TINA factor. There is no alternative. So in preference-wise, where do you think your FIs are looking?
I think this is what's so fascinating about emerging markets now. When I started doing emerging markets, and certainly over the last decade or so, if you took a call on whether you wanted to invest in emerging markets, it was whether you were overweight or underweight China. It was very simple. China used to be 40% plus of the emerging market index, and now actually its weighting within the emerging market and compared to India is actually very similar. So I don't think it's become an either-or in that sense. I do think when you're looking at China, though, when you're looking at three components which really drive a bull market, it's valuation. So starting valuation's got to be cheap. You've got to have under ownership, and that's what you've got in China at the moment. And then you have an earnings inversion. So when we see what's happened to China tech over the last few months, it's that implication of an earnings inversion which is really driving it. Because of DeepSeek, because of the belief that AI and cloud growth is now going to come back in force, that's what's driven that growth. Now, for there to be a longer-term China bull market, we need to see a significant change in consumption patterns in China. So saving rates in China at the moment are record highs. That's because there is no confidence in the Chinese economy at the moment from the consumer. They used to put money into property. That was an asset which continued to appreciate in value. That gave them confidence. Then they went into the markets and spent that. Property market in China, as we know, has been in the doldrums, and there's no obvious return of that. So until we see that return in consumption confidence, I still think there's a good balance between China and India.
Just your thoughts on, Alibaba, by the way, was down 10% last night. And a lot of talk whether this is, we've had lots of false starts in China over the last 3-4 years, right? But those starts, while you're in it, seems like the real thing, because those rallies have been 50-60% in some cases. But do you think this is different now? And, we got the government behind with some fiscal, some monetary efforts. And there's this AI bit as well. And of course, that shines a spotlight on all the technological prowess that China has, generally speaking.
So great question. I think on that side, historically, China's had these very strong bull markets when they've come out with the fiscal and monetary bazooka. What we've got to understand with China is that until there's a significant change, the overriding policy direction in China is around renminbi stabilization and making sure that renminbi can become an international currency, potentially replacing the US dollar to some extent. When you have that policy in place, it means your ability to have a strong fiscal or very high fiscal or monetary stimulus is limited. Therefore, it's going to come down to more individual aspects within the market. So when we're looking at China, it's very much specific stocks, specific sectors. There is not going to be a general kind of consumption growth or economic growth in China of the likes that we've seen previously at this point, unless you get a significant shift in that in that policy change.
The other big question, of course, is the US, right?
Yes.
Lots happened in the last, 1.5, it seems like years with daily headlines, etc.
Yeah.
What does it do? You look at emerging markets closely. What does all of what the Trump administration is doing or wanting to do mean for money actually going into EMs? Because, the signal is that, everything should happen in the US.
Yes.
Forget the rest of the world.
Yes. Yeah.
What's your sense?
So it's interesting. I think we're going to definitely have trade wars or tariff implications 1.0 and 2.0. So 1.0, I think, was a genuine reset, and the Biden administration continued this to some degree, of too much was being imported into the US, not enough was being produced domestically, we need to adjust. And we've seen significant supply chains adjust around the world as a result. At this point, and it's always difficult to tell with Trump, but at this point, the indication is that tariff wars 2.0 are more of a lever rather than anything else. And so what we've seen so far, the tariffs that Trump has come out with on Mexico, what it's come out with on Canada, to some extent what it's come out with on China, has been a bargaining chip for other aspects of the economy or for geopolitical considerations. So it's uncertain at this point as to whether we're actually going to see those tariffs carried through. Now, we've had some headlines this morning around further semiconductor implications and regulations and restrictions on particularly exports out of Europe and semiconductor equipment coming out of Europe and coming out of Japan going into China. So I think you're going to continue to see that aspect going forward. Where I think it's very different.
Although some are convinced that with the majority that he's got and
yes.
Actually, if anything, it's going to be tariffs 2.0 is going to be even more forceful and more decisive, and he really wants to do it as well, more well thought out as compared to what we saw in the first term.
I would agree with that to some extent, but I also think a key KPI for Trump is what happens to US stock markets. He's going to want to start at a certain level, he wants to finish at a much higher level with the US stock markets.
Is that possible?
Well, this is the point. So I don't think it's possible to have much higher US stock markets if you have inflationary regulation coming through or inflationary inputs coming through. So if you come through very aggressively with very high levels of tariffs, that will be inflationary. That will lead to higher US interest rates. And therefore, what is the possibility of US stock markets going higher on the back of that? So I think that could act as a natural cap to the level of tariffs that Trump is coming through.
So Trump will use it more as a negotiating tool, is what you're factoring in?
That's the indication at this stage. But as I say, the Trump policy, as we know, can be quite volatile.
Can US be down meaningfully when EMs be up? Can the if a top? Some are already talking about whether a top is in for US tech.
Yes.
If the US were to pull back meaningfully, can money? Can EMs do well?
Of course. Yeah. Put it this way: year to date, if you're a over the last decade, if you're a global asset allocator, where would you have made money? You didn't need to put money offshore from the US over the last decade. What we would say there is that the valuation differential between EM and DM now is at its largest point that it's been for many years. Therefore, when we're being approached by our global clients, they're very much aware and cognizant of the fact that they have a large overweight in the US and they tend to have large underweights in emerging markets. You get a move like we've just had in India over the last few years, a move like we've had in China over the last 6 months. That concerns asset allocators. So I think you'll see a natural drift of assets from developed markets into emerging markets.
So simply put, at Manulife, what's the call now on US markets from here on emerging markets, and within emerging markets, the preferred bet? And why do you think India's FIs will make a comeback into Indian markets in the second half?
I won't, as the head of emerging markets, I'm not going to comment on the US at this point. But what I would say is that when we look at emerging markets at the moment, we're very constructive on emerging markets going from here. As I mentioned previously, historically, when you took a view on emerging markets, it was whether you were positive or negative on China. I think what's fascinating with emerging markets right now is that you could allocate individual capital to India, you could allocate individual capital to China. If you look at what computational supply is coming out of the likes of Korea and Taiwan, that is on its a standalone investment case on its own. And within LATAM, we're also very constructive of individual companies within Mexico and also within Brazil. So I would say that from a valuation perspective, that emerging markets and Manulife are very constructive on emerging markets at this point going forward. and we'd certainly be nominating more capital.
And within emerging markets, your preferred destination for capital?
So we are very much a bottom-up stock picking company. So we don't start with a top-down. This is how much we should have in individual countries. So the opportunity set we're seeing at the moment is very much based within India. We're now thinking that there's some really interesting, particularly in the mid-cap space, where we've seen a lot of pullbacks.
Could you name a few themes in India that you like?
Yeah, so there are a couple of themes I'd like to go through there. I think the internet platforms in India, the duration of growth that you have within the Indian internet platforms is quite extraordinary, and I think that's something we'd be very interested in. So whether that's the food delivery side, whether that's the online travel side, whether it's the fintech side, those are all businesses that we're familiar with, and we'd be very positive on those on a longer term basis. And I think this pullback gives a good opportunity within those individual areas. The other thing we're very positive on is actually the IT outsourcing within India. This is a sector which had very strong double-digit growth many decades ago, obviously slowed down more recently. We actually think it's a very big positive response to AI and the introduction to AI to companies around the world.
Yeah.
You can imagine if you're a mid-cap company based in Europe or the US, you have an IT department of 10 people, your CEO comes to you and says, how are we implementing AI? You don't have the resources to do it. Right, well, I'll go to some of the large Indian IT outsourcing companies, and we're actually seeing some inflection in their earnings growth on the back of that as well.
Okay, consumer internet platforms and IT outsourcing as a theme. Great chat, Charlie. Great that you could come down to our studios, and I hope it's the first of many.
Of course.
I really appreciate it.
I'd love to come back.
Thank you.
We look forward.
Great. Thank you.
All right, well, we'll just take a quick commercial break here. We've got the market, which is steadier. But don't get too excited. It's just 50 points. 22,600 plus is where we're at. Market breadth is positive. Some 3:1 in favor of advances as things stand. We'll come back with Neeraj Sharma of One Source Specialty Pharma. That's a chat you don't want to miss. Coming right up in a bit.
Welcome back. Well, let's turn our attention to One Source Specialty Pharma. The stock has been a little bit under pressure in the last 1 month or so. The GLP-1 demand is expected to be a big growth driver for the company. Also, they plan to double their revenues, improve their margins in the next few years. To discuss this, the outlook in terms of growth, we're joined by Mr. Neeraj Sharma, the CEO and the Managing Director at the company. Hi, Mr. Sharma. Good morning, and thanks a lot for joining in. I recall when you joined us the last time around, you told us have some patience, wait for the results, and then we'll talk more in detail. So that's the opportunity now. The EBITDA number has been improving on a quarterly basis. So Q4, do you appear that you're on track to do around $20 million approximately? And in the next 3 years, do you see that annual EBITDA number move to the vicinity of around $130 million by FY 27-28? Should that be the target?
Yes, indeed. So as we have said, as in this current fourth quarter, yes, we have given a guidance of in excess of 20 million our exit run rate. And in the next 3 to 4 years, we have said we'll be a 400 million revenue company with a 40% EBITDA margin. And a lot of it is driven by our drug device combination biologics business, which is a very strong revenue and EBITDA driver going forward for us.
So just extrapolating that number, $400 million of revenue with 40% margins means you'll do around $160 million of EBITDA by FY 28. Bang on?
That's it. Yeah, that's what we have said. In the next 2 to 4 years, that's exactly what we are aiming to do.
Okay, all right. Let's talk about capacity then. Could you tell us what is your current capacity? I believe you're increasing capacity as well. So what is the total capex you're going to be incurring? Oopsie. Okay, all right. I think we'll wait by, to get the management back. But as Mr. Sharma says, Currently, they're doing a quarterly run rate of little around $15 to around $18 million approximately. That number will move to around $20 million in quarter 4. And in the next 3 years, that run rate on a quarterly basis from $20 million in quarter 4, the quarterly run rate will move to around $40 million. All of this in the next 3 years or so. So we'll wait for the management to join back in. But by the way, the markets, at least we have a fair bit of green on the screen. Quite a few stocks trading in the green. The markets as well, the headline indices are trading well, but the breadth of the market is positive. You have 1,800 stocks that are advancing, which is good news as we speak. And SBI Cards, the stock had started off mildly in the red. That's seen a bit of a U-turn because their spends were better than the industry, and the market share on a month-to-month basis has improved as well. So SBI Card, after starting off in the red, that stock has moved into the green. So we'll keep an eye out on that one. By the way, from the broader markets, actually, a few stocks have moved to the high point of the day. Chambal Fertilizers, big move is what we're seeing on that one. The stock had started off more or less flattish. Now it's up around 3.5%. Abbott is the other one as well that's moved higher. And the two new entrants into the Nifty, you'll be having Zomato as well as Geo Financial. Yesterday, the markets were quite nervous. So that's why we did see both those two stocks ended in the red. But I think both those two now at the high point of the day. Mr. Sharma is back with us. Mr. Sharma, you were telling us about your capacity addition plans. Current capacity, where is it headed? And what is the capex plan?
Yeah, so the current capacity, we are at 40 million cartridges, which is, as I said, among the highest in the industry today. And we are actually going to take it to anywhere, excess of 200 million cartridges. And this will be over next 3 to 4 years. And in fact, to achieve that, we have already said that we will be investing about $100 million in new capex in this time frame, and significant part of this new capex will be on the cartridges and the drug device combination expansion.
Okay, let's get to funding of that. And could you tell us what is your current net debt number? Because if I look at the interest cost for the past quarter is around 46 crores on a quarterly basis. So if I extrapolate that number, it'll come to in a vicinity of around 180 to around 200 crores of interest costs in an annual basis. What does this mean about your net debt currently? And given that you have a capex plan of around $100 million, where is this number headed?
Sure. Actually, if you saw that we have actually significantly reduced our net debt, we brought it down by half, almost from 140 odd million to 70 million end of the last quarter, which is quarter ending December. And, and we expect, because as I mentioned to you, the kind of EBITDA numbers which we are already generating and, anticipate to generate over the next 3 to 4 years, we expect most of this capex will be through our self-accruals already. The cash we'll be generating ourselves. And there's also customers who are participating in our capex program. So from a debt point of view, we have said, we are ending this year less than 1 time, debt to EBITDA. And we will actually be doing, we are going to be a net debt-free company in the next 3 to 4 years.
All right. So what does it mean in terms of interest costs, sir? Because, as you're saying that the net debt number has come down by half, but if I look at your quarterly run rate in terms of the interest cost, that's still at around 46 crores. So
we have, just to let you know, we have significantly reduced that in third quarter. You saw that we had raised almost $100 million of primary investment before our listing. And we have used a significant part of that to reduce and retire our high-cost debts. So therefore, going forward, you will see our debt servicing cost coming down quite dramatically.
So on a quarterly basis, it comes down, say, to around 20 crores per quarter. Should that be the run rate we should look like in terms of interest cost?
So I don't have the exact interest cost number, but I said the total debt has come down by half. So we expect the interest cost. In fact, the interest cost will come down lower because simply because our debt servicing percentage also is coming down. Especially you would have seen our ratings have gone up quite significantly by rating agencies. So all that is going to have a positive impact on our debt servicing.
Okay, all right. Final question before we let you go. GLP-1 is expected to be a big growth driver for you. and you've indicated that you have got a fair bit of inquiries as well. What about conversion of these kind of inquiries into business, revenue potential, and from which geographies are you seeing higher traction?
So GLP-1s, you see, we were the pioneers as CDMO in this area, and we still feel we are, from a CDMO space, a very, very significant player. In fact, we already have, 20 plus customers in this area, and these customers are the global who's who in the generic space. So we will be a very significant player in this market as the market forms. We already our first customers are launching liraglutide in the major markets this year, and when semaglutide, which is the largest GLP-1, which comes off patent in key markets like Canada, Brazil, starting 2026, we will continue to expand, and our revenues will continue to show that. So it's a very important drug, and one source will be a very significant player in the GLP as the generic market starts forming.
All right, we'll chat more. Thank you very much for coming on the program, sir. Appreciate your time here on CNBC-TV18. Thanks indeed. Well, let's put the spotlight on the Indian healthcare space now. Indian hospitals are eyeing significant capacity addition. There are also, of course, lots of business houses which are making it clear that they want to enter the hospital space. We've heard announcements, at a high level from groups like the Bazaar group, from the Adani group, and others, of course, also indicating that they are interested. What does this mean for the existing sort of supply-demand dynamics? Let's bring in Ankit Thakur, who's CEO at Jupiter Lifeline Hospitals. Viren Shetty is Executive Vice Chairman at Narayana Health. Gentlemen, good morning. Great to have both of you here. Thank you very much for joining us. Viren, if I can start with you, Prashant this side. Sort of broad thoughts first up. Private equity and financial players have always been interested in this space. It's steady growth, lots of demand. But you're seeing more and more industrial groups, conglomerates wanting a piece of the pie. What do you make of it?
It's a good thing. This is a huge market. We are one of the fastest growing markets for private healthcare in the world, and the most underserved population in the world. The more people that are out there making hospitals for people that serve the community, it's better for the country, right?
Obviously it won't be immediate because you'll need to set up, unless of course these groups buy out hospital chains. That's different. But if they're going to set up from ground up, it's going to take time, right? How do you gauge? Of course, there's no question, demand far overwhelms supply. But what about quality care? Sort of quality health supply, Viren. How do you gauge that with all these plans being announced now?
It doesn't necessarily compromise on the quality of care you're providing. See, the thing is, CapEx is just one of the levers in which you provide, that is adding beds and capacity infrastructure. The other is getting good doctors, getting good systems in place, training nurses. And invariably, you will have a system where the more hospitals there are, the more it naturally brings up the standards for the entire industry. And the fact that there are these very large business houses that are interested in it, obviously it's better for the industry because then maybe it gets more of a sense of organization to the place, and there will be a lot more interest in investing on healthcare as a lot of those input products. So for example, very little medical equipment is made here, very little consumables are made here. A lot of this is brought in from outside. The larger the domestic healthcare industry grows, the more entrepreneurs come in and start becoming suppliers to Indian hospitals. They're not just looking at export markets. So yes, long term, this is something that would only benefit the industry.
Sorry, my question, and that's a great answer, but my question more to make it clear was from a effective purchasing point of view. Affordable, the segment of population which can afford treatment at the kind of hospitals that you run, others run, etc. In that context, a lot of this supply starting to come in, Viren.
Yeah. So that's when you start to really get to the meat of the argument, right? The fact is a certain amount of investment requires a certain amount of return. Those of us who borrow from banks, from private equity, or those of us that are funding it out of other balance sheets, you're looking at the return on capital. and the huge amount of investments that come up in land, building, doctors, and so on. If you're looking at it from a 10, 15-year perspective, there's a certain amount that you need to charge to customers to be able to recover that. If you're looking at this from a 25, 30, 40-year perspective even, then it's possible that you are providing something that's of net benefit to the customer, does not raise the overall prices of the industry, and you have customers who are getting quality healthcare at a good price. Whereas if it is the notion that this is something that in 10 years you're going to make a solid return on the investment, obviously you will make your customers pay a little more than what they're used to paying, but those are business choices. There will always be customers that are willing to pay more for the same levels of care. There will be customers who may be a little more price sensitive and will not be willing to pay more. And there is a market for everyone. And it's just that some of us play in certain markets and others that play in other markets.
Ankit, hi, morning. Come into the discussion. We've seen PE investments in hospitals before. Has the fabric of the DNA of the hospital changed after a PE player has come in, to your mind? And if yes, in what way? And also jump in on the argument that how PE players ultimately are in to there is a pursuit of profits. They're in to make some money, which could be a conflict with the idea that, healthcare should be affordable for all.
Well, I think for a long time, healthcare has been an apologetic industry. And I think that needs to be addressed and corrected. I strongly believe that integrity and business can both be used in the same sentence. So this whole notion that someone who is trying to make a return, as Viren was saying, is simply not bothered about any integrity or any ethical standard, I think I would like to disagree with. So going forward, yes, with PE coming, industrial houses coming, and the government especially signaling that healthcare could be a privatized industry, a lot of us listed on the exchanges, it is acknowledged that a return has to be made. But at the same time, I think it is also quite clear that the integrity and ethical standards have to be kept high. As far as affordability is concerned, I think the aspiration has to be to afford healthcare through an insurance system. Nowhere in the world a quality healthcare cost is within the reach of an average person out of pocket. So the aspiration for affordability has to be through the insurance procurement. And that is the way we need to look at it.
And have you seen the DNA of hospitals change after PEs come in with deep pockets?
I think each company has a different DNA. We, for one, have never had a PE investor on our board, so I can't really speak a lot with personal experience. But yes, each company will have a different DNA. I would not want to broad brush the entire healthcare and PE sector in this response.
Viren, you smiled.
Let's see.
Do you want to? Yeah, come in.
Healthcare as a public good is a public provision. And there is scope for advanced Western economies with massive tax bases that are able to support a large public healthcare system without the notion of whether this needs to be run efficiently or in a very tax efficient manner. We are seeing in real time the decimation of that business model, both in the Western world, the United States, United Kingdom, where large publicly funded healthcare systems are really lagging behind. The business of healthcare, healthcare is a modern enterprise like any other, requires massive investment, billions of dollars in R&D, huge amounts of digitization, huge amounts of work involved in providing very, very specific high quality levels of care that are simply not capable of being provided without a well laid out structure of incentives. You can no more expect the public provision of healthcare as you can the public provision of semiconductors or jet engines or any other modern industry. Now, let us not take away from the fact that people are feeling the pinch that in all parts of the world, the increased privatization of healthcare is causing a hurt on people's pockets. That absolutely is the case. But as with any industry that has large amounts of private sector participation, it opens up different business sectors for different participants to play in. There are those that would operate in a much more cost-efficient, low-cost model, and that will cater to a certain segment of the market. There are certain players that will say, we will play it to the higher end of the market and provide very luxurious accommodation and very fancy infrastructure, and that is fine as well. There should be different sorts of business model that provide healthcare. Now, PE in the end, like any other fund, if you say private equity, if you say SBI, anyone who's financing this industry is looking for the return of their money. It's just that the sources of capital are very different and the business model we build around that have to cater to that. So we should not, as Amit was saying, don't be apologetic about the fact that there is investor interest in this industry. As customers, you should celebrate more choice coming in here. And the incentive structure, I'm not saying it will sort itself out. There is sufficient scope for regulation. There's sufficient scope for consumer choice that will create the best options for customers over here. But a busy industry with a lot of inbound investor interest over the long term is better for all of us.
I think that's well put. We could have gone on, but we are short on time. But it's an interesting conversation, which I think we will continue to have. You know, it's a balance, as I think both of you put it. Viren and Ankit, thank you very much for joining us. Good speaking with both of you here on CNBC TV18. I think we'll sort of look at the market for a bit. 45 points higher, 22,600 or so. Mitesh is back with us. Mitesh, just a quick word on the price action. Anything you're seeing? Any trades?
Nothing much on the index, Prashant. To be very honest, I think, you know, the first thing which is of concern to me is that yesterday we had a gap down which had a high of 26,668 and the upper end was 22,720. So I think, you know, if we get around closer to those areas, I think I would want to take some short positions. So around 22,670, 660 zones, take a stop about 22,720 and trade on the short side. A reversal will happen once we cross 22,800, but the first stop loss should be 22,720. But on the stock side, there are some interesting, you know, stocks to look at on the, particularly from the long side of trade. I have a buy on CG Power, which I would recommend buying with the stop just below 595 for a target of 630. And the other one is a buy on Nestle. Nestle has given a good reversal on the hourly and 2 hourly charts. So buy here. Keep your stop at about 22.10 and look for a target around 22.85.
Thank you. We will slip into a break on that note. On the other side, Manisha will join in to focus on commodities. Welcome back. The Nifty is now closer to 22,600. M&M is the top gainer, up more than 2%. On the way down, the correction or profit booking in Hindalco continues. Hindalco is down more than 3%. But Manisha is now here with us for the latest on commodities. Manisha.
Well, thank you for that. I'm looking at the crude oil prices where we have seen gains for coming in for a second straight day. Remember, it was on Friday that we saw the crude oil prices decline by 2.7%. But the last two sessions, including today, has seen some gains come back. We are trading above $75 a barrel for the Brent crude oil prices. Well, support comes in from the fact that the U.S. is looking to impose more sanctions on Iran oil. That could mean disruption in supplies. The other important factor clearly comes in from Russia-Ukraine conversations. From what we know right now via reports is that the European Union will hold emergency summit on 6th of March to discuss support for Ukraine. And on the other side, you have US directly talking to Russia, excluding European Union and Ukraine for that matter. So that tells you that we're not at the end of this conversation yet, and there are way too many factors, and that also has had some premium on prices. The other thing is about OPEC and allies, and all eyes on the March meeting, really, because we are looking at the street talking about withholding 5.8 million barrels per day production to support market. This has been happening for last 2 years now, and OPEC has been wanting to get some of this production back on road, but we have seen 5 postponements come back in sense of rolling off these production. Now, the next one comes in for the month of April, and we will know whether or not OPEC and allies are increasing production in the month of March. That is when that meeting will happen, telling us on what really can be expected in April. The other thing is that many of these OPEC members, whether it's Kazakhstan, Iraq, UAE and Nigeria, have been increasing capacity. So whether or not they will hold on to their agreed quotas that OPEC has allotted is yet another question mark that the street is looking at. And then you also are looking at higher production continuing from US. We already are looking at 13.1 million barrels per day coming in from US, and a record 13.6 is what the targets are for this year. So higher supplies from there as well. More importantly, it is going to be about tariffs, and Trump has reiterated that tariffs on Canada and Mexico will proceed as planned. Well, if that happens, then we are looking at some disruptions, some concerns in the global markets and inflation as well. And that in turn also seems to be supporting crude oil prices, at least at this point in time. What you would want to focus coming forward is the U.S. Personal Consumer Expenditure Report that comes in on Friday. And then there are 9 speeches slated from the U.S. Fed officials in this week itself. And that perhaps would tell you on where the economy, tariffs and interest rates are going. So that is yet another thing to watch out for.
All right, Manisha, thank you very much for that. That's commodities in focus. Well, coming up after a quick commercial break is an interesting conversation on the trend of foreign MNCs listing in India. Remember, Hyundai was the big one, and many more are coming up after that, at least in the near future. Cyril Shroff of Cyril Amarchand Mangaldas and Raj Balakrishnan of Bofa Securities India will sort of tell us whether this is a trend which is going to be durable, what are the reasons, the motivating drivers, coming up. Hello and welcome to this special chat. Markets may be down recently, but the current pullback follows what has been a period of exceptional returns for the last few years. Consider the statistics. The mid-cap index CAGR returns for the last 5-year period ending 2024 is 27%. The same number for the small-cap index is 26%. The CAGR returns for the Nifty for the same period is nearly 15%. Well, you'll call that modest versus what the mid and small caps have done, but still higher than Nifty's 25-year return scorecard. The booming markets have set off many new trends in the markets. The question is whether these trends are fleeting or here to stay. One of the trends has been foreign MNC companies listing in India. We've had Hyundai India's near 28,000 crore IPO, the largest Indian IPO ever, which really put the spotlight on this phenomenon. Reports suggest a healthy pipeline as well, LG India being a prominent next one. We have Norway's Orkla, which owns MTR Foods. There has been talk of hair appliances trying for an IPO. Hindustan Coca-Cola Beverages has been rumored to be in the fray as well, and many more. What is the reason behind this interest, and is this durable? Well, we have 2 gentlemen with us who will bring us the answer. Cyril Shroff is the managing partner of Cyril Amarchand Mangaldas. Raj Balakrishnan is co-head of India Investment Banking at Bofa Securities. Gentlemen, great to have both of you here. Thank you very much for your time on CNBC-TV18. Mr. Shroff, if I can start with you. First up, is this a departure, what we've seen recently, all this interest, the listing? Or it's not really? I mean, it's, because of the Hyundai IPO being so large, it's being seen as one. What is your sense? Put this recent phenomenon into some historical context for our viewers. Go on.
So I think this is the beginning of a trend, and Hyundai is not the only one. I think there have been a number of issuances already of similarly structured companies, and there are many more in the pipeline as well. And it is really a reflection of what is happening in the Indian markets and the Indian economy as well. I think the starting point, of course, is the Indian economy being on such a strong growth path with the economic fundamentals, then the depth and the robustness of our domestic capital markets and the ability to list as well. There's also an issue of relative valuation in the home markets of the parent as well as their Indian subsidiaries or the Indian entities. There is a massive delta between the two as well. And it goes without saying that what we are observing is that the Indian market is offering a very high multiples and success at listings as well. And apart from foreign multinationals kind of choosing to list in India, there is also the start of what you might have heard of as the kind of reverse flip or the ghar wapsi of kind of Indian structured businesses, or where the majority of the business was in India, but the companies were registered offshore for offshore listings as well. They're flipping back. and coming back to India as well. So it starts from the same starting point of the Indian market is a very attractive place to list, not only for Indians who had gone out and are now coming back, but also multinationals who are choosing to list their Indian subsidiaries over here because there are very, very strong economic and commercial reasons to do so. So it's a trend.
It's a trend, and it's with the start of one, Mr. Shroff, that's what you're saying. Raj, as a veteran banker, I mean, your insights on this. I remember when the Hyundai IPO was happening, we were talking about how in Korea, that business gets about 5 times multiple. Here, of course, I mean, auto companies get anywhere between 40 and 50 times. Is that the big attractiveness, the kind of valuation that you can get here in India? What are your thoughts?
So the way I look at it is that the valuation of the India businesses of these entities is for good reason, which is that the India businesses of a number of these multinationals are growing faster, are more profitable, and probably have a much longer horizon of growth than their home-based businesses. And effectively speaking, so you have this jewel in the crown, so to speak, for a number of these companies, which is not getting the right reflection and the right valuation in the parent company valuation. So we've seen this happen in other sectors around the world. For example, you've had a number of companies globally listing their tech subsidiaries or spinning off businesses in order to try and identify and unlock value. And I see the India subsidiary IPO as a continuation of that trend. So you've got businesses which are growing very rapidly, which are extremely profitable, which are leaders, and the market in India rightly gives these businesses very high multiples, which hopefully will help unlock value for the parent as well.
And you would agree with Mr. Shroff that this is the beginning of a sort of trend, an acceleration, a trend which is perhaps will accelerate going forward?
I agree fully. You've had a number of multinational companies, and I won't take any specific names, which have built extremely strong businesses in India over the last 30 years, but you've seen very few of them listing. And with SEBI having simplified a number of the regulations around listing in India with a few successes, I think what will tend to happen is you'll see boards of parent companies and their shareholders taking notice of the fact that, hey, we've got this great India business. It's something which, our peers in India who have listed subsidiaries, their entities trade at very, very high valuations. So why should we not be looking at this quite seriously?
Are there any other reasons, Raj, apart from the valuation, which you say, rightly so, because growth rates here are much higher, but are there any other compelling reasons?
It becomes a very attractive means of raising capital for the parent, right? So you have a number of these examples. So, for example, Hyundai was entirely a secondary sale. So that money went back, it's hard dollars going back to the parent, representing a return on the investment that they have made in India. Secondly, it also signifies a commitment of the company to the Indian market. And for any company which has got a strong consumer brand, helping their consumers become stakeholders in the prosperity of that business is always a positive as well. And so I think it's a combination of factors. It is a commitment to India. It's a commitment to the Indian consumer, helping make your consumers your partners in prosperity, so to speak, as well as a great way of getting cash back, return on investment back to the parent without giving up control.
Hyundai is now, but the good old Maruti, right, is just a shining example. I think even now, the Maruti India listed entity perhaps contributes, if you do a SOTP, perhaps the bulk of the big driver for the overall Suzuki business is, the Maruti, the India sort of subsidiary in that sense. But of course, we consider Maruti a homegrown business, even though it is an MNC. Mr. Shroff, Raj briefly alluded to the regulatory landscape, etc. as well, and you sort of alluded to that in the first response. Could you expand on that? What is that looking like? Has it become easier over the years? Has it become more welcoming?
Oh, absolutely. And what Raj mentioned, and building on some of my introductory comments, is that what has happened now is that effectively the Indian markets are unlocking value for the world. it builds on the many themes that are going on, Make in India and things like that. The newest addition to that slogan is unlock value in India, particularly when you have entities like the subsidiaries over here where you could access the Indian capital market. But now coming specifically to your question, I think the answer is yes. If you go back in history, exit in India was very difficult. It was very problematic for tax reasons, just the administrative protocol. Now it is so easy to do that. So amongst the regulatory changes that have enabled this is that exit on the market through an offer for sale. Many of these are through offer for sales, have become much easier. The listing norms have also been simplified. For example, the minimum public float that is required above a particular capital size has been reduced in order to enable these, because these are very large businesses that have built up over a period of time. And if the full 25% was applicable for listing, I think the companies would have struggled. So the regulator and the policy environment has been very practical in enabling this by making all these adjustments that were required in order to enable this. Also the corporate governance rules. I think there is an assumption that these sort of companies have better corporate governance, which is why they command better valuations and get better higher multiples when they list as well. So the change in and the tightening of and more clarity in relation to the corporate governance framework has also been a contributory factor. So all in all, if I can call it, the regulatory mahal has been sufficiently adjusted to enable these transactions to happen. And now they happen in a jiffy.
No, and I think the depth of the markets as well, right, Mr. Shroff? Whirlpool, for example, wants to, I think the global CEO was on record last year. It was saying that why not take advantage of the valuations? They did one round, they're doing another round. And of course, the market is deep enough to absorb that. So there is that as well. What are the size of the opportunity in that sense? Raj, if you want to take that. If this is we're at the beginning of a long trend, how large is this going to become? Will we see a couple of listings every year, large ones?
I think it's actually a massive opportunity. If I were to just look at the kind of dialogue that we have, we probably have a dialogue with, several multinational corporations evaluating the possibility of a listing in India, literally 2 or 3 such dialogues every month. So there's several companies which have built very, very strong businesses in India. Now, of course, a decision to list in India tends to be seen as a somewhat irreversible one, or at least something which cannot be reversed easily in the short term. And therefore, people do evaluate these decisions very, very carefully. But I do see this as a trend where you could see not just 1 or 2, but several companies getting listed each year for the next several years, if I just look at the number of MNCs that we are having dialogues with.
Okay, a couple of every month basically is what you're saying, at least in terms of conversations. But of course, they take their time before deciding. Mr. Shroff, same question to you, size of opportunity before we drill it down to more specifics?
Massive, and by definition, many of these transactions are very large. They're all $1 billion plus as well, just in terms of the ticket size of several of these transactions. So I agree with Raj completely, and he and I probably are part of many of the same conversations as well. And the reason for that is the economic reason is that the multiple that is available in the Indian market is so much higher than in the home markets that it's in many cases it's a no-brainer. And there are many large. If you just go through the list of MNCs that have large businesses in India and are potentially listable. There it is, and you will get a sense of, there are American companies, there are European companies, there are Japanese companies, there are the Korean company. Hyundai was a Korean company as well. So the economic argument is very straightforward. I think what the multinationals have to get used to the idea is that they will then have to deal with the Indian regulatory environment, and the Indian regulatory environment is different from the home environment. In some ways it is stricter, in some ways it is is more liberal, and in some ways it has yet to evolve into a kind of a more mature state. But that is happening all the time. So those are some of the trade-offs, but a lot of that gets trumped just by the delta in the valuation. Sometimes it is the home market gives you a 5 or 6 multiple, and here you get 40, 50 as just to take an example, and I'm talking of an actual case. That is the level of difference.
So it's worth the trouble, if I can use that word, Mr. Shroff. That's what you're saying. And
very, very, very nicely put.
And also, is there? Have you looked at the number of companies we can look at? I mean, you did say all countries from around the world are here, right? In terms of business operations,
yes,
etc. So have you done any kind of exercise which potentially puts a number to that sort of a figure there?
So I think what Raj said, I think we are all involved in a couple of conversations every month. And all of them will make a visit to Raj and to me. But we're not going to talk names here.
Okay, no, absolutely. Fair enough. Confidential conversations. And of course, we'll know when we know.